Okay, well, it's a good question, Greg. I mean, the fact is that when we envision typical FSRs in the past, what we're thinking through are tail risks, major events that essentially happen to the economy and their effects get magnified, and then those vulnerabilities that we've identified manifest themselves as financial stability risks. The important thing that's going on here, which is not in those typical scenarios, is that we have a truly historic fiscal response mixed in to the to the scenario. Excuse me. And so all those income supports and other facilities which are aimed at companies are serving to mitigate the effects of the shock that normally we would be very preoccupied with during that sort of magnification stage of a shock. And so when we do the stress test, normally in the FSR, none of those things are present. In this case, they are. And so we show you in charts, I think they're 14 and 15 or 13, 14 anyway, in the towards the latter two-thirds or latter third of the piece. Comparison of our best estimate of what the kind of counterfactual would look like. Much higher mortgage arrears, much higher defaults or loan provisions, I should say, from firms. And so the difference between those two lines is how the policies are acting to cushion the blow on the economy and therefore on the financial system at the same time.
So clearly households have sustained quite a change in their lives, either on the income side, although some of that's been offset by government actions, but also just in terms of the containment measures and what that means for their ability to access the housing market. And so, yes, we have seen a decline in listings, we've seen a decline in sales, as you would expect. And along with that, the price expectations have softened quite a lot, as you quite rightly note. The way we're thinking about it is just to look forward and see that once the containment measures are gradually lifted, that the housing market across the country should spring back to life. How long will that take? What's the exact timing? It's really hard to tell at this point. That's why we're working on scenarios. As we learn more about what the lifting of the containment measures looks like, we'll be able to be more precise about those scenarios. But certainly, if you kind of roll back to the end of last year and even to the beginning of this year, the housing market had very strong fundamentals, very strong underlying demand. And in fact, the discourse was the opposite. And so in the sense that people were worried in certain areas if we wouldn't see a return to some froth that had already been taken off in previous years because of changes to taxes and macroprudential policy. And so one can imagine that at least some of those fundamentals are still there, including supply issues. And so there's every reason to believe that the housing market will firm over time once the economy does.
This is a very central phenomenon to the outlook. And it's why, if you go back to the NPR, there was such a big difference between scenario 1 and scenario 2 in the NPR. Underneath that, all there is, the main difference is a longer passage of time of containment. And that passage of time means each month you're adding more and more stress onto those companies. And so at a certain point, especially possibly companies that entered this in less good shape than was ideal, then the stress builds up very quickly. So the shorter the containment period is, the less of an issue this becomes. The reverse is the longer it is, the more it is an issue. And so in the FSR, what we've analyzed is actually the more dire of those two scenarios, okay? Because that's the FSR's territory is kind of if you like, a tail risk kind of territory. And so what it's showing is that there is quite a meaningful increase in in non-performing business loans in the dire scenario, but with the policy actions that we've taken, that we and the government have taken, but a rise to like around 6% of non-performing loans. That is a pretty big rise that we're projecting in chart 15, but that is not a projection, but is consistent with, as I repeat, the dire scenario from the NPR. And we estimate in this chart 15 in the FSR that it would be far more difficult for firms without those mitigating policies that the government has put in place. So are they as perfect or as effective? It seems not quite as effective as what we're seeing on the household side, but still very effective. And then in the company sector, then what we've got is other backstop things available through BDC, EDC, and so on that are, there's access to credit channels that are not always, that as easily to tap into. And so I'm comfortable that this thing is going to work. But as again, just to respond to the essence of your question, is it all depends on how long this containment period lasts. As I said, we've got some positive signs now that we're starting to open things up, and that's going to make all the difference.